Hi, I'm Iain Henderson, Senior Wealth Manager at Abbey Wealth. I'm very conscious that with a number of you, I've never actually had the opportunity to put a face to a name, so I thought I'd take this opportunity to introduce myself by video. Today, I'm in London meeting with fund managers on some of the funds that we use in our active portfolios. Please find enclosed an interview I held today with Charles Hepworth of GAM Investments. Thank you very much.
So I've been involved in the financial market since 1992 when I first started out as a private client investment manager. Then graduated on to running institutional money, and now finally I've positioned myself at GAM to run their risk-rated model portfolio service. So a hard Brexit would be categorically the worst outcome for UK risk assets at least, but also European risk assets as well. Given that clearly there's a lot of trade between the two trading nations at the moment, the UK and European countries, it would be systemically the worst outcome, obviously, in all of the Brexit negotiations. We're not currently expecting a hard Brexit likelihood. There is a probability of it. I mean, it's not low. It's probably around 25 to 30%. But our expectation is there is going to be some cobbled together agreement at the last stages of the negotiations that are still ongoing. The pound has been under pressure throughout this year. The real kind of downward pressure that we saw in sterling was really after the referendum result back in 2016. But obviously going forward, until there is any resolution to the end state of Brexit, we don't think sterling really is going to be a very attractive asset to hold. So currently on the portfolios we're positioned outside of sterling. We have hedge positions overseas as well, but really if we're going into a harder Brexit environment, then you'd expect to see sterling weaken considerably from here, nearer to 120 against the dollar, and probably nearer to 110 against the euro. So not too far from where we are currently, but still further pressure downwards from here. Our expectation is, as I said, there's going to be a likelihood of some agreement eventually that they'll deal with, and that should provide a little bit of a fillip to sterling. But currently, we just don't think it's probably the worthwhile trade to put on, because volatility in the currency is going to be quite extreme. So President Trump has had a clear impact on financial markets since his election win back in 2016. The S&P has been on a tear really since that date. 2017 was a standout year, and even into this year, equities in the US have continued their upward kind of march. Until more recently, if you look at the really since the performance since May onwards, equities outside of the US, so world equities ex-US, were struggling, whereas US equities were continuing to go higher. A lot of this is down to clearly his stimulus that he's enacted through tax cuts in the US. It's a kind of sugar high stimulus, which you wouldn't normally expect at this stage of the kind of US economic cycle. These sort of things that he's doing, you would enact in recessionary periods, and he's doing it in what is actually quite a hot running economy. So it's actually quite dangerous, his policy that he's adopting. And on that basis, we're becoming certainly much more circumspect really on holding very overvalued US equity positions on the portfolio. So we've been reining a lot of that exposure back throughout the course of this year, seeing better opportunities elsewhere. Trump ultimately is a change agent. He's ripping up the script, certainly on the political scene, and he's had an outsized impact on a lot of risk assets since his election. But he is a big risk. Let's all be clear about that, because he doesn't follow the kind of normal script that everyone, or investors at least, are used to. So the trade war that he's currently forging with China is a worry for markets. Clearly it's had a disproportionate impact on Chinese equity kind of performance this year. They've entered bear market territory on the equity indices in China, and clearly a lot of the exporters in China are suffering with the trade tariffs that Trump seems fairly keen to enact on all the imports they're taking in from China. So there is definitely a slowdown happening outside of the US because of these tariffs. But then bear in mind, a lot of these tariffs are going to hit the US consumer quite painfully at some point. Current estimates on the current tariffs enacted so far would suggest about a half percent kind of downdraft in GDP numbers in the US. And if he goes full nuclear with the complete tariff enactment, which he's threatening with, that would lead to about 1.5% downdraft in US GDP. So, it's not a great idea. No one wins a trade war ultimately, and he seems to think that he's going to win. I think the markets will probably tell him otherwise sooner rather than later. So I've touched on the US kind of equity positioning. They're expensive. If you look at just on price earnings, US equities are roughly about 17 times. That's at the upper end of kind of long-term average. They're priced for peak optimism, peak stimulus, peak kind of running hot economy in the US, which ultimately can only go one way from here. We believe that's down. So that ultimately will lead to lower US equity kind of values. But having said that, there are other opportunities elsewhere around the world. We've got Japanese equities trading about 13.5 times, so considerably cheaper. European equities about the similar 13.6 times. But emerging markets are the screaming standout on valuation terms because they're trading at 11 times now on a price earnings multiple. So great value in some of these markets that we can still gain access to. And we think over the course of the next few years, that's going to be where you're going to be seeing outsized returns.